Hey everyone, we're back at TradetechFX in sunny Florida. It's day one. I'm joined by Edgewater Markets, Matt Kassel and Brian Andreyko. Guys, thanks for taking the time to speak with us today.
Thank you very much. Pleasure to be here.
I could see that you guys are one of the sponsors of this event. You guys are doing a lot of stuff in Latin America these days. I just saw an announcement that you guys opened up an office in Brazil recently. Why Latin America?
Latin America has always been an amazing opportunity for all financial market participants, and with the development and the rollout of technology in the past, call it 5 years, it's just been an obvious destination for Edgewater to go to. We've always had a large presence in Mexico, and we've spent an enormous amount of time building out a network of clients that need technology specifically, need credit intermediation, and we have just been spending our time on building technology to suit the needs of clients specifically in Latin America.
And I think your office opening sort of timed well with new Forex or FX regulations in Brazil. I think kind of like relaxing some of the things there in the country. Was that something that you guys had planned? And also, do you think, what do you think this new sort of FX law in Brazil is going to do to the local market?
Well, I think it's step one for sure. I mean, all the countries in the world that have currencies that trade in as non-deliverable forwards have been designed to prevent large outflows from the countries. And in order to have a more free market, free-floating currency, you have to start to take initial steps to deregulate the entire market. And this is a big step because it's step one. It's always the hardest step. And I think in the coming year or 2 years, you're going to see more activity, more investment, more financial movement of money into Brazil and at times out of Brazil. And it's in those periods of investment and pullback that you'll see just how important it is to have that free flowing of capital markets to be able to support emerging markets.
And I think it's larger than Brazil, right? Like we started in Mexico. We do cover the Andes top to bottom. We have an office in Santiago. It's important for us to be close to our markets. So we've opened an office in Brazil. We've opened an office in Santiago. We believe firmly in boots on the ground, and that's what we're employing down there. So it's a bit, as Matt said, we provide the tech. We also provide the execution service to facilitate both the onshore market as well as the onshore offshore market, and that's really what we're after here.
And I think the APAC region is also an important region for you guys. I think recently you announced that you had hired a managing director in, I think in Singapore. Tell me a little bit about what you guys are doing in that region specifically, because I know, in terms of the institutional firms and everyone else that needs your trading services and your solutions, obviously they have different asset classes, let's say, than perhaps are the most traded there as they are in Latin America or the United States or elsewhere?
Sure. I mean, all the NDF pairs in the world, 7 or 8 of them in Asia, 4 or 5 of them in Latin America, they all have somewhat similar mechanics behind them in that they trade in a rolling 1 month or 3 month or various broken dates. And the Asian NDF market is huge. Dollar Korea, dollar India are 2 of the largest currency pairs in NDFs traded globally. So it's just a continuation of our plan from Latin America rolled out into Asia. They are emerging markets, but they are becoming developed markets, and it's just because that they're an NDF that it makes it more nuanced than a G5 developed nation.
Yeah, and it's apropos for this conference. I think I'm giving a talk on NDF algo trading, right? Which is where really the way you start that to happen. I mean, first you need technology, and you need credit, right? So all of the things that we talked about with LATAM are very applicable there. We find the right banks, the right partners, and we help them scale their business on a global level, which is really the piece that has been missing in these markets, which is why the timing is good right now.
And it's super important to be able to empower the locals onshore, whether they be in Brazil or whether they be in Chile or they be in Korea or India, that they have the control and that they have ownership and market share of their currency. So our technology is going to empower them and empowering them, it offers the larger marketplace access to liquidity that they've never had before, and that makes markets more efficient, and hopefully grows each one of their market participants' market share.
And I think it's a very important time too, because with the volatility that we've been seeing, domestically, let's say in our markets, and the increase in risks, counterparty risks and things like that. It seems like demand for NDFs is continuing to grow and grow and grow, and so is basically the interest in emerging markets, right? And like you said, Matt, if there's a lot of outside interest in these emerging markets, we want to make sure that sort of there's this turns into a fruitful relationship for everybody in a sense.
Of course, we could be talking about Latin America, we could be talking about North Africa and frontier markets, we could be talking about Middle East, or even the developed markets out in Asia. It's all opportunity, and the interest that's increasing in NDFs is because there's an interest increasing in investment in each one of those regions. And as that investment continues to increase, the interest in NDF trading is going to only increase, and we see the NDF market nearly doubling in size in the next 2 to 3 years.
But here's I'll throw a curveball. Obviously, NDFs, like we said, they're growing for many different reasons, but including the fact that we have interest rate hikes, right? The volatility and things like that. What if the interest rates go back to zero, and what if volatility diminishes and the geopolitical risks somehow disappear? How do you think you would have to sort of diversify or change your business in a sense?
Yeah, we just came out of that period, right? Like we had 0 interest rates and no volatility, right? So, and we actually grew quite steadily and heavily during that period. So, especially in these emerging markets that are less efficient, providing that technology, building the relationships, creating that onshore-offshore facilitation, it's going to scale. Like these guys are used to one relationship with one global bank. To open that up and have them have a direct relationship with global macro players. I mean, they price asset managers, pension funds all day long onshore. Now they can do that offshore in their currency pair where they have an edge, right? So it's really helping them grow their business as well.
I wanted to actually ask you also regionally. So I heard that Brazil, I think, and Argentina are working on a common currency. I think it's called Sol or something like that. Kind of, what's your impression of this, and do you think that that's something that's actually viable for the future?
Yeah, so there have been a couple of articles written on that. This isn't the first time that this topic came up. It was being discussed 7 to 10 years ago, actually as early as the late 80s, after various monetary controls of the Louvre and the Plaza Accord. And so it's just being reintroduced back into the markets. And if you look at the euro and the creation of the monetary union there, that started in 1992 with the Maastricht Treaty. It took them 7 years until 1999 for that to even be, even rolled out. It's a very difficult process. Brazil is obviously the larger economy of the two, so they're going to have a larger role and stake in whether or not this actually does go through, much the same way that Germany and France, with their larger economies, had a larger say in how the euro was rolled out. So it's something everyone to keep their eye on and to keep checking in. There's a couple of steps that need to happen for that to become a reality, and monetary union without political union is pretty difficult. So
that's the key point, really, right? Like, 'cause
we will see how close their policies are in 4 years from now. They just had elections recently, and they both elected to the same side of the political spectrum, right? So that's where they are now. We'll see in 3 or 4 years, and if they can maintain that alliance and that political symmetry, then they may take the next step, and that's how we're going to get from A to B, I think.
It seems to me like if we look at the sort of the geopolitical risks that we've seen in the last year, and we look at the euro, right, and the pound, this happened to the pound as well last year, right? We kind of saw it approaching parity. We did see euro sort of approaching parity. There was a lot of sort of, I would say, scaremongering. Oh my God, Europe's not going to have enough gas to heat for the winter, and so there might be an economic, maybe not a collapse, but there would be, economic losses and things like that. But it seems like the euro, if you look at the euro today, it fared fairly well. I mean, it's what 1.6, 1.06 today, or whatever it is, something like that. Do you think maybe all of these types of world events are also sort of giving positivity to the authorities in Argentina and Brazil in terms of kind of like what's the next step in our goal of having a common currency?
Well, anytime that large economies join with other economies and they become a larger economic zone, it gives them clout, it gives them trading leverage, it gives them some stability. The problem that you have with the larger the institution you have is that in times of stress or hardship, the risks become larger as well. And that's why when there's problems in Europe or there's problems in the UK and you see the pound fall 20% in a matter of a couple of weeks and the euro falling 20% in a matter of a couple of months, it's scary. There's a lot of money at stake, and there's a lot of businesses and a lot of real money interest. There was the pension fund in the UK that was at risk at one point, and size is protective, and it's also very scary when things go off the rails.
And I think for those markets, right, there's only more chance of increased volatility and political problems, right, which was the basis of that question. From that perspective, it's going to prove difficult, but it's going to be on them to kind of sort it out.
Both of you guys in previous interviews have talked about the interconnectivity, right, as being the future of global FX and commodities markets. Really getting rid of the so-called middleman, right? Improving, I think you guys mentioned things like anonymous trading and non-anonymized trading and things like that. How do we get there?
Go ahead.
This is the best topic to talk about because it really highlights technology and ability to scale your business with technology. If you take an example like Amazon, for example, many people are transacting on Amazon. They don't necessarily know who the buyers and sellers are, but the business is getting done and there's less middlemen involved. And you can see what happens with that type of business once it starts to scale. FX is no different. It's just another product in another industry. By connecting traders in Tokyo with traders in Lima, Peru, with traders in North Africa, with traders in the Middle East, with traders in Vietnam, you are interconnecting people that have never traded with one another before. And it creates a larger sandbox. And in that larger sandbox, you have many more direct connections between market participants and less middlemen standing in between. That loss of that middleman, that direct connections, even though people don't know whom they're trading with, is efficient. It saves costs. Execution services create a lower cost of trading, and that creates more trading. And it's going to be very transformative, and we're really in the mid stage of that development. Whether it be the ECNs that have built products in the last 5 to 10 years, exchanges that have built products in the last 5 to 10 years, and now it's about connecting regions of the world that don't have ECNs or exchanges, and they haven't had access to amazing technology, and they haven't had access to credit. And now when you bring all those into one, there's going to be a larger marketplace out there shortly.
Yeah, and we've seen it with the primary pairs, right? Like the Canadian banks taking control of CAD, right? The Australian banks taking control of Aussie. This is no different than that. It's just a matter of giving them the tools to play on that global scale, the bigger sandbox. Like they need the same tools that the global banks have, and that's really about what we're giving them.
My final question is, so under your business model, you guys say that you do not widen prices during times of heightened volatility. How do you guys go about doing that?
Well, it's a commitment to our clients. During periods of stress, whether it be Brexit or the S&B fallout or Trump's election, COVID, the Ukrainian invasion. You can go over the course of 15 to 20 years there. The markets liquidity becomes much more precious. And our clients have told us numerous times that we become their number one liquidity provider in those times of stress. And that's when relationships really matter. And when nothing's going on, anybody can be an extremely tight price. But when people really need it, when the cost of executing is higher, we plan to be there for our clients, and we will not widen our rates to our clients and take advantage of market opportunities, but we will, tell our clients when things aren't so busy that you need us to be there for when things are going to be, a bit more wild, and we'll be there for you. You need to support us all year round when we support you.
It's all about the relationship. You had it right.
I was going to ask also, Matt, is that part also because, again, the liquidity that you can provide as opposed to others is just on another, I'm not going to say it's on another level, but in terms of the access to liquidity, the sources of liquidity, again, with you guys, we could argue or say that in times of heightened volatility, they may be advantageous for firms that need to protect themselves.
Absolutely, you're only as good as your liquidity when you need to get in or out of a position in times of market stress. And to build a pool of liquidity that can stand up to market stress, you need to go to people that have had experience with it and success with it in the past. It's no different than any other decision-making tree that you would make any other time.
And it's also, again, bringing it back to the originator of the liquidity, the owner of the currency, right? When you start doing that, they're there in times of volatility always for their pair. Maybe not everything, but for their pair, and we make those connections happen. So that's really what helps facilitate that and makes it go.
Last question, final question. Because you work in so many different emerging markets, which ones are the ones that are seeing the highest demand right now, especially like in the FX space?
So there's two components to that. There's a demand for the currency and the actual volume traded in that pair, and there's demand for technology to be able to trade those currency pairs and handle the increased volume that goes with it. So it's not quite a straight line answer. I would say that Latin America has been a region that has been in need of technology for so many years, and they're slowly getting that now. So they're coming up to speed. The next area of frontier markets or emerging markets that are going to be expanding in that space is going to be North Africa and the Middle East, and both of those areas are in need of technology. They're going to in need of credit and credit intermediation, and they're in need of execution services, which is what Edgewater spends its time facilitating for our clients. So I would say that those areas would be our.
And when we speak about Middle East, are we speaking about Dubai? Because in our world, Dubai right now is a very, very hot, people are saying it's not a financial capital of the world, but it's a very, very big hotspot, even for our industry as well, in terms of FX and crypto companies, both retail and institutional. Do you see Dubai sort of playing a role in the Middle East in that way?
Yeah, absolutely. I mean, I was just there a few months ago, and Dubai, Kuwait, Egypt, they're all kind of, again, it's the same story, right? I feel like I'm repeating it, but they want control of their currency pairs. They want to scale on a global level. For that, you need the tech, you need the credit, and you need the execution services. We bring that together and help them trade, with Chile.
Very cool. Very, very cool. Guys, thanks for taking the time to join us. I know you guys are busy speaking on panels. Everybody make sure to check those out probably on the TradetechFX website. Thanks for joining us. Good luck the rest of the way. We hope to see you soon in Stanford.
Thank you.
Thank you, guys.